Let's bring in Chance Finucane, partner, chief investment officer, Oxbow Advisors. Glad you're here with us, Chance. So what are some of the things investors do that we should really note? Because it could, in fact, hurt their long-term success.
Yeah, thanks, Nicole. I think the first thing or the worst thing that an investor could do would be to let their emotions drive them to sell out of all of their financial assets completely, to go to 100% cash. This is usually an emotionally driven decision. It could be after a significant market decline, or it could be when stocks are at record highs and someone is concerned about there being a plummeting of the markets on the horizon. But regardless, we don't like this sort of discretionary decision making, because when you go to 100% cash, it means you're needing near perfect conditions to then get back into the market, which could leave you waiting for a long time and missing out on future gains. We saw this with articles we all read in the Wall Street Journal in 2015, telling the stories of people who sold out at the bottom in 2009 and 5 or 6 years later had still not bought back in. So that would be the main thing that we would caution against doing.
Right. I mean, you could really miss some big jumps higher if you just take it all out in cash. You don't actually take a loss until you sell everything at a loss. And then you miss the big days. So how do you reduce the chances of being the emotional investor? What's the optimal way to adjust your portfolio? There's economic cycles to consider. Tell me more about that.
Yeah, I think first to reiterate, we would not make any all-in or all-out decisions. It's better to make smaller adjustments to your portfolio, that periodic rebalancing. And we also would focus more on trying to remember how much risk you're capable of handling emotionally. Our managing partner, Ted Oakley, is working on a book right now called Your Money Mentality that gets at this, where you need to really be honest with yourself about how much risk you can handle in the markets. An easy example to use for this is in the last 20 years, we've had 2 separate occasions where stocks went down by 50%. And if the idea of your investments in stocks being cut in half, if all of your savings were cut in half, would be something that would cause you to lose sleep at night and really be on edge, then that probably tells you shouldn't have 100% of your money in stocks. You might want to balance it out with some allocation into bonds, cash, or maybe defensive real estate.
Yeah, tell me about that allocation, because how do you allocate money needed for the short term? You talk about 401ks, IRAs, a regular taxable account, tax deferred, all of these things that you're listing. Tell me about allocating between these different types of accounts.
You're right, Nicole. I think having these tax deferred accounts, 401ks and IRAs, can be real beneficial for a person regardless of where they are at in their life. One benefit of these tax deferred accounts for retirees is that the dividend income is non-taxable. So for anyone who's trying to live off of their dividend income, taking those withdrawals out of high dividend investments in your tax deferred accounts is a good strategy. But the second advantage we really like with tax deferred accounts is for anybody that has at least a decade to go before they would start making withdrawals from their IRAs or their 401ks. That's something that they can take advantage behaviorally, where if you're not going to make any removals for at least 10 years, you don't have to worry about any of these short-term oscillations in the markets. You can invest more of your money in these tax deferred accounts into stocks and just set it aside and walk away for decades, knowing that they're very likely to have more purchasing power by the time you would be starting to make some withdrawals.
What do you think about what's going on with the market now? I mean, I know you don't time the market and you don't go all in or all out. How are you telling investors to put some cash to work in 2021?
Sure. I think when you see people do rebalancing, I think one way to do it is to do things on a time-based manner, such as rebalancing once a year. So after you saw stocks go up so much these past 9 months, that might be a good time to rebalance a little bit out of stocks and into safer assets like some bonds. But one way that we prefer is volatility-based rebalancing, which is more basing your decision-making off of rules around how much the stock market is going up or down. So one example of this would be for every 10% decline in the stock market, reallocate a little bit of the money from your bonds and cash holdings into stocks. So one situation you could see that happen in was in February and March of last year, we had a 34% decline in the S&P 500. If you were using that sort of strategy, that would have given you 3 separate times that you could have allocated more money into stocks at good prices.
Makes sense. It really does make sense. When you talk about different strategies and different ideas, one thing you mentioned was defensive real estate. Tell me a little bit about that, because you said bonds, cash, or defensive real estate. What do you mean by that?
It's a good question, because I think everyone has always thought that real estate is a more defensive asset class. But what we just witnessed with the start of the pandemic and the decline that we saw in February and March is that there are certain areas within real estate that are going to act more volatilely than they might have in the past. So if you look just at the beta of certain sub-industries of public real estate or REITs, there's only a few areas that are still acting defensively, moving less volatilely than the market. So that would be something like towers, data centers, some public storage type, self-storage facility REITs, things of that nature. Whereas other areas like retail and office have gotten more volatile and are not acting as the same sort of safe place to get some income that they might have in decades past.
Yeah, so you have to be more selective there. Chance, great conversation. We appreciate it very much. Chance Finucane.